As long as there's money, there'll be people trying to steal it. The methods used to steal money vary greatly, but one common way in the cryptocurrency space is by way of a pump and dump scheme, otherwise known as a rug pull. And in this video, I'll take you through what a pump and dump scheme is within the crypto space and the things that you'll need to look out for to spot one. But first, make sure to subscribe to the channel and press the bell icon to stay across the latest videos from Kalkine. Pump and dumps are where a crypto's price is artificially boosted by an organised group who purchases a large volume of a particular coin and in turn pushes up the price. Once the coin's price reaches a previously agreed upon target, a signal is given for the manipulators to sell, thus selling it at a much higher price and raking in a sizable profit. These schemes usually involve influencers who are paid to tell people to buy a particular digital coin in order to raise its value. Then, once the value goes up, the scammers and influencers sell their coins and pocket the profits, while everyone else sees their investments lose value. Now, the scariest part is that these schemes are carried out in broad daylight. These particular pump and dump schemes differ to other types of scams in that there's little to no trickery involved. Instead, retail traders willingly participate, believing that they'll be able to beat the zero-sum game. In the stock market, pump and dumps are illegal. One of the most well-known examples of the pump and dump scam was conducted by Jordan Belfort, also known as the Wolf of Wall Street, and his company on Wall Street throughout the 90s. While the Australian regulatory body, the Securities and Exchange Commission, or the SEC, has outlawed such activities in the stock market, it doesn't yet have similar rules for cryptocurrency. Part of the issue is that new cryptos pop up by the dozen weekly, given that they can be fairly easy to create provided that you know the necessary coding required. However, developers of pump and dump digital currencies are unlikely to build a whole blockchain. Therefore, be wary of any coin which doesn't have an accompanying blockchain like Bitcoin or Ethereum. So how can investors avoid pump and dump schemes? Fear of missing out, or FOMO, among traders can create anxiety, which often leads to a gambler's mentality. FOMO can be combated by conducting thorough research. If you see a coin doing the rounds on social media that's promising high returns, look into that coin's white paper and its developers. If the developers are anonymous, for example, that's typically a pretty big red flag. If the white paper is devoid of crucial details or absent altogether, then that's another major issue. Looking at the historical performance of a particular coin can also be extremely useful. Though of course, the issue with pump and dump schemes is that early data is easily corruptible. So here's the bottom line. The crypto space is moving at an alarming speed. This means that it will take time for regulators to catch up with this ever-growing technology. As such, investors must stay vigilant and be constantly learning and researching, because sadly with human nature, if there's money to be made, people will look for avenues to easily procure it, even if that is at the expense of others. So above all, do your research, be smart and be vigilant, and don't become a victim to a pump and dump scheme. If you enjoyed this video, please subscribe to the channel, leave us a comment about what other crypto information you'd like us to look at, and of course, don't forget to press the bell icon to stay across the latest from Kalkine. For more info, just head across to the website, kalkinemedia.com. I'm James Preston, reporting for Kalkine.